virtually impossible to have a course on technical analysis without discussing pattern recognition. And in this chapter, we'll be looking into such esoteric names as head and shoulder patterns, double bottoms, double tops, wedges, and the like. Let's take a look at the axiom of an uptrend. Although Dow theory was concerned with the overall interaction between different indices and attempted to gauge the health of the business environment, his work on technical analysis is still applied to any chart in any time frame. A bull trend made up of a series of higher highs and higher lows. On the chart, this is referred to as rising tops and rising bottoms. It doesn't matter if this is on a 1 minute chart or a 5 minute chart or on a daily chart or whatever time frame you're looking at. But it raises an interesting point which I want to make sure you understand and appreciate immediately. My own trading strategies are based on the principle of fading the short-term trend in the direction of the long-term trend. It means that if I see the trend on a 15-minute chart is up, I will buy the dips on the 5-minute chart, even though it looks as if the market is moving lower on the 5-minute chart. I am essentially fading the move on the 5-minute chart in the direction of the move on the 15-minute chart. Fading means I'm going against the trend. I'm doing this because I want to trade in the direction of the trend that I am following. We'll talk about this concept in far greater detail in chapter 12, but for now, I want to take you through some of the most popular trading patterns. It's called pattern recognition. What you should know about these trading patterns is that they can occur on any time frame. But it is important that you realize that the longer the time frame you are looking at, the more significant the result is going to be. But it may also take longer to unfold. The trading channel is one of the easiest patterns to trade. It is simply a question of connecting a high with the next high and project it in a straight line into the future. It gives you a projection of where the next move in the market will run out of steam. I've included a couple of charts for you. The second chart demonstrates this concept on the Euro-Yen chart on a 30-minute time frame. As the trend moves lower, the parallel line does a great job in forecasting the potential support for the currency pair. At this point, as a trader, you may either consider initiating a long position, or if you had been short the market, you may want to move your stop down tight to protect your profits on your position. The uptrend on this chart follows the parameters for one of the fundamental laws of technical analysis perfectly. The market is progressing higher in a series of higher highs and higher lows. But what I need you to focus on, though, is where the market stops on the retracements. A retracement is a move against the prevailing trend. One of the primary laws of technical analysis is that of support and resistance. It states that once an area of resistance has been broken, it should now act as an area of support, i.e. a place where traders will be looking to buying. In this case, you can view a previous top as an area of resistance. Once that top has been penetrated by the price action and the trend is carrying the price higher, you can draw a horizontal line through the old high to indicate that this area may now be a place where traders will be looking to buy. The law states that once old support has been broken, it may now become new resistance. And once resistance has been broken, it may now become new support. Now, you may think that I'm a bit woolly in my expression here, but I use the word may simply because there are no certainties in the market. Anything can happen. So it would be wrong for me to say that it categorically will become support or resistance. This stair-step pattern is the hallmark of a trend. And as you will see next, the same principle applies to the downtrend. The downtrend is simply the opposite of the uptrend. Here we are seeing a series of lower highs and lower lows. On this chart, I have shown a trend line break, which is often a good indication that one type of trend is over and a new trend is starting. You should notice how the lows on the way down now define areas of resistance on the retracement moves higher. This is the hallmark of support and resistance and trend analysis. If you are looking to get short the market, the place to consider placing the position is in the area of resistance as defined by the horizontal line from the old low. The double top is one of my favorite patterns. It's easy to spot in that you are looking for a market which is trading at or near an old top. In the chapter on candle charts, I talked about different styles of trading. As a trader, you can be aggressive, or you can be neutral, or you can be more cautious. I would not like to say what I recommend. I think you should find your own trading style. For me, I am sometimes very aggressive in my trading style, and sometimes I'm neutral or even slightly cautious. It varies with the circumstances of how I feel about the trade that I want to place or the market in general. For example, if I know that a major holiday in the US is approaching, I tend to be more cautious on my trading approach because I know many traders will have left the trading desks early, and that can severely affect liquidity in the market. When it comes to double tops, I like to be aggressive though, if the market warrants it. I prefer to sell short the market at or even just above the old high, speculating that the market will reverse back down again. I need to have some compelling reasons for doing so. It could be that the larger time frame I'm looking at is still trending down. A more cautious approach would be to wait for the market to print a bearish candle after having made the double top, such as a bearish engulfing pattern or a doji, and then go short. An even more cautious approach would be to wait for a trend line break like you're seeing on the chart in front of you now. It depends on your trading style. The more aggressive you are, the more you will make when you are right, because you're getting in at a better price than if you wait. However, the drawback is that you're not waiting for confirmation and you may have jumped the gun by going in too early. It's a fine balance between risk and reward, and only you can answer what is best for you. The double bottom is traded in an identical manner to the double top. I have printed the volume figures underneath the chart to indicate that volume is surging on the lows. So whenever I trade stock index futures, I will inevitably look at volume as well, because I know from experience that volume will surge when important highs or lows are made. Looking at it on a graph with the benefit of hindsight is one thing, but actually trading it in real time is a different matter altogether. However, if I can get you to recognize the patterns in the calm and the comfort outside the trading ring, there's a much better chance you will recognize them when you are in the thick of the trading day. The most widely recognized pattern in the financial markets. I've heard die-hard journalists on Bloomberg and CNBC talk about this pattern. And it is true that the forecasting power of the head and shoulder pattern is quite powerful. It is easy to spot, but it may not be so easy to trade. It depends on how aggressively you want to trade it. Let's have a look at the setup. The market is making a series of higher highs and higher lows, so we know the trend is up. The first real alert you receive that a head and shoulder pattern is forming comes when the trend line, which has connected all the lows, has been broken. The patterns often form a horizontal or near horizontal support line. On the head and shoulder pattern, this is called the neckline, and it is an important ingredient in the pattern because if the neckline breaks, the head and shoulder pattern has been confirmed. The right shoulder is the place where I, as an aggressive trader, will be looking to place a short position for a bearish head and shoulder pattern. I will be looking for the market to make a candle pattern indicating that the market is heading lower. It could be an engulfing pattern or it could be a doji. Most patterns come with a target price. for the head and shoulder pattern, the target is calculated as the distance the market has traveled from the top of the head to the baseline or the neckline. The target is found by adding this distance to the base of the neckline, projecting a target to the downside. The much less aggressive approach to trading the head and shoulder pattern is to place a short sell order near or at the baseline or neckline and hope that the market will come back and fill your order once it has broken through the neckline. Sometimes the market simply runs away when the pattern has been confirmed and you may not get filled at all. The inverse head and shoulder pattern will signify that a low is in the making. It can be traded exactly like the head and shoulder pattern, and the warning will, like the head and shoulder pattern, come when the trend line has been broken. One important aspect of the head and shoulder pattern and the inverse head and shoulder pattern is that the volume tends to decrease on the middle part of the pattern. If you're trading a stock or an index, you should take a look at the volume and get a sense of the declining volumes for the confirmation of the pattern. Some of the patterns that I frequently trade are nothing more than continuation trades. They're called continuation patterns. It means that I'm looking for patterns where I feel the market has gone into a temporary sideways range before continuing in the direction of the trend it had before entering into the consolidation. A typical bullish flag tends to go into a channel, and within the channel you'll find 3 peaks and 3 troughs. When you trade what you perceive to be a bullish flag, you have several choices. You can be aggressive, or you can wait for confirmation. An aggressive stand would be to attempt to buy point E, where the market is touching the lower end of the channel before it pushes higher. Point E is the most optimal place to trade from, but you're also at a point on the chart where there's absolutely no confirmation that the bullish flag is about to materialize. If you wish to wait for confirmation, you will wait for point C to be broken. This is the point where the market breaks through the trend line created by the 3 lower peaks within the trading channel. The unique feature of the bullish flag is that it comes with a price target. On the price example, the base is made at 85 and the top of the first leg higher is at 90. Once the market has traced out the sideways trading range, it breaks out from a trend line at 89, and given the first leg up was 5 points, we would expect a bullish flag to move at least another 5 points higher from the point where it broke the trend line. The bearish flag is exactly the opposite of the bullish flag. We are again expecting the market to trace out a sideways range of 3 ways up and down within a channel before resuming the downtrend. The initial move lower on this example was from 150 to 145. Once the market breaks the lower trend line, I will again expect it to move in the same distance as it did before coming into the channel. But remember, the use of targets is only a guide. The trader will have to assess the market and move their stops as they see fit. My personal feeling about trading is that I want to move my stop loss to break even as soon as I reasonably can. My view is that the sooner I can get a free trade out of the market, the better I am positioned. In the field of pattern recognition, you will encounter pennants, symmetrical triangles, as well as ascending and descending triangles. All of those will appear on the screen while I explain how they are traded. But remember, they are all pretty much identical in nature. All of them make use of trend. They're all considered holding patterns before the original trend continues, whether that is to the upside or the downside. As such, you can view these patterns as a temporary pause in an existing trend. All those patterns can be traded in any time frame. It doesn't matter if you're using them on a 5-minute chart or on an hourly chart or even on a daily chart. The principle behind them is the same. There's a pause in the trend, and this pause tends to play itself out in the form of 3 legs up and 3 legs down before the trend resumes. Of course, this is a rather stale way of viewing the markets, and if anything, you will by now have realized that I firmly believe that the markets are fluid, and as such, your approach to the market should be fluid too. The ability to change one's mind in the face of changing circumstances is one of the primary traits of the winning trader, if not the most important one. The patterns shown here have the ability to forecast the end of the move. The theory for pattern recognition states that the length of the move going into the pattern will be the length of the move coming out of the pattern. You may recall how the head and shoulder patterns measure the length from the top of the head to the baseline or the neckline, and then projects the length of this line from the point where the market penetrates the neckline. Well, the same holds true for the patterns discussed in this section. It could be a useful tool for traders to have some idea of how far the market is likely to move. But there's also an inherent danger in having too rigid a mindset about how far the market will go. If you cast your mind back to the chapter on trend analysis, you'll remember how much emphasis I put on the merit of trends and how they tended to move a lot further than most people anticipated. So the best thing you can do for yourself and your education in pattern recognition is to learn these patterns off by heart. It won't take you very long to commit. They're pretty much all similar in nature. But from then on, it is a question of beginning to recognize them in real time and begin to observe their behavior. What you have been presented with here are the typical patterns, but don't forget that in the financial markets, things rarely pan out exactly as it is described in the textbooks. And as such, it's a good idea to keep an open mind and above all, always have a stop loss in place whenever you're trading the financial markets, because in this game, anything can happen.